Good morning, everybody. Hello, and welcome to another very special edition of your Bitcoin economic calendar, the news and analysis that you need to know for the week ahead in Bitcoin. Today is Monday, December the 28th, and we have the last Bitcoin economic calendar of the year 2020 today. So with that, some very special topics to cover. We have Bitcoin finding itself squarely in price discovery mode after breaking all-time highs. We're going to look at the options markets to see what investor expectations are telling us of how high Bitcoin can go in this rally. We're also going to talk about how US private banks don't have to hold a single cent of client deposits since March and what this means. And we're also going to talk about what we can expect for Bitcoin in the year 2021 to close it off. So with that, onwards to our analysis. So starting as we usually do with Bitcoin, first off, happy new all-time high, everybody. We saw that Bitcoin had another great week last week, settling the week, closing at 26,258, up 11.85% for the week. Now, as we've been mentioning here, this was likely on the back of very, very strong institutional momentum and appetite for Bitcoin. We also had this morning, we also had the Bitcoin CME Futures actually get halted at limit up for a brief period of time. While this is impressive, it's not necessarily always a good thing, as many market makers use the futures market to offload some risk. So this may have some impact into the spot price. Seems like everything is back to normal right now, but important to watch out for, as we can see that they are up quite significantly this morning, up 16%, the CME futures, as they close during the weekend. So they have a lot of catch up to do from the weekend's rally. We also have Bitcoin, as we mentioned in the intro, squarely in price discovery mode. What does this mean? It means that it has basically broken all types of resistance that were previously visible on the chart. So people are naturally wondering how far or how high Bitcoin can go. And a good place to look at this as to what investor expectations may be are the options markets. So if we look at Deribit right here, we are looking at the June 21st strike price. And a good thing to watch is how where in the further up in the price we see some volumes in call pricing, or call options, sorry. So these are people that expect the price of Bitcoin to reach these levels in the future, this contract being June 25th, 2021. So if we look at this contract, we see that we have some quite interesting volume in the $40,000 strike price for June. We also have pretty decent activity in the $32,000 strike price for June. But most interestingly, we also have some decent open interest in the $56,000 strike and the $60,000 strike, as well as the $72,000 strike. So there seems to be quite a range of expectations, with people essentially pricing moves all the way up to 72K. Now, if we go and look at the September strike prices, which is again the same concept but just a bit further out, we see again that the $40,000 strike has some pretty decent open interest. Similarly, we see the $80,000 strike with some pretty decent open interest. And lastly, but certainly not least, we see some pretty significant action as well on the $100,000 strike price, which again, these are expectations of investors essentially positioning themselves for potential moves up to these levels. Now, in other news to cover for Bitcoin, we also saw later last week that Ripple was hit with a lawsuit. We're going to just open the Ripple chart here quickly to see last week's move. We see that it was basically down over 50% for the week. It actually closed the week slightly below a drop of 50% or 49%. What does this mean? Well, this is the lawsuit that the SEC filed against Ripple is a very serious lawsuit that essentially charged it and two executives with the sale of unregistered securities to the tune of $1.2 billion. This sent Ripple and the altcoin markets tumbling after the news. Although Bitcoin's standard rally was enough to have some speculators FOMO back into the space and essentially help Ripple catch a bid along with some of the other altcoins. We have seen this in the past, and with Bitcoin soaring through the holidays, there is a good chance that market speculators try to relive alt season, only to have the SEC damper the party in the coming months with more enforcement announcements. Now, as far as what we can expect for Bitcoin going forward, we're going to talk about expectations for 2021 for Bitcoin in today's episode in our What's Ahead section today. Moving over to the S&P 500, we see here, this is last week's candle right here. We see that it closed last week's price, essentially moderately lower at just down 0.17%. And last week, this was on the background of some posturing between Democrats and Republicans around the stimulus that was being proposed in the US. We had Mr. Trump go out vocally and said that he would request a higher amount of stimulus before basically considering signing the bill. Then we had the Democrats say that they would, very gladly comply. There was some posturing back and forth. So the move from last week was not violent in either direction, as it was essentially waiting for confirmation. This morning, we got the news that President Trump is actually intending to sign the stimulus bill this morning. This has basically caused the markets to open again at all-time highs. Now, the other headwind that may be apparent or present in the markets in the coming days will be the fact that there is a alleged new strain of the virus out of Britain that seems to be much more contagious and is causing some travel restrictions in Japan and some other places. So this may continue to be headwinds. However, we're seeing from, given today's news, that there seems to be a clear path for a new stimulus bill in the US, which will likely keep lifting markets higher. Again, in the context of the stimulus bill being passed and an aggressive Fed, investors will likely expect markets to continue grinding higher. Now, moving over to gold, we see that it had an interesting, basically, price action last week. It bounced lower and higher and closed the week just slightly lower, at 0.10% lower. Now, this was interesting because it had some decent volume. If you look at the gold ETF, for a relatively short trading week, it had some very decent volume. And given the backdrop, it is rather unusual to see gold not moving higher and essentially having very strong volume to settle essentially neutral, which leads investors to believe that perhaps some gold investors are looking to take profits and look for more upside in places potentially like Bitcoin. This is interesting price action to keep our eyes on. We do see that it's moving higher this morning, likely on the news of the stimulus, but again, something to watch as it continues to underperform Bitcoin to the upside. Moving over to the DeFi index, we see that last week it had a very unusual or impressive candle with very, very strong price moves to the downside, and then essentially recovering all the way to close the week just slightly lower. Let's break this down. As I mentioned earlier, there was this big Ripple news that caused not just Ripple, but all the altcoins and anything that might be impacted by a potential unregistered security, which was what the SEC charged Ripple with. Essentially, it sent anything altcoin related tumbling after the news as people digested how this may impact other parts or other types of tokens. Now, having said that, even after taking a beating, Santa's Bitcoin rally, which was very impressive, had the anti-gravity effect that it can sometimes have with altcoins. And essentially, the DeFi index did a Hail Mary rally. Let's look at the daily just so that you guys can see. Essentially, it did a Hail Mary rally on yesterday and today, really. To yesterday actually was a big price move up to close the week just slightly lower. Again, this was very likely due to the strength on the Bitcoin and Ethereum rallies. But as we've been mentioning here, the DeFi index continues to underperform both Ethereum and Bitcoin to the upside. If we look at last week's candle for Ethereum, we see that it was basically up 7.40%. Bitcoin, as we've already discussed, was, sorry, I'm just looking at the weekly candles. So Ethereum last week was up 7%. We see that Bitcoin last week was up 11.85%. And we see again that the DeFi index in the same period was down 1.39%, which is, very much in line with our analysis, our previous analysis. So just to recap this, fairly or unfairly, a rising tide floats all boats in crypto, and an inevitable slew of I want to buy the new Bitcoin investors and Bitcoin is too expensive investors will all move in and continue to bid up, well, pretty much everything. It is likely that the index, though, continues to underperform the protocol level assets to the upside. And if and when this changes, it could be a sign that we are approaching a local market top. So something to keep an eye on. So in today's market trends sections, we're going to talk about what the M1 money multiplier is and why the Federal Reserve broke it, basically. So first, let's start with a quick recap. In a fiat system, central banks are the creators of money. And in a fiat system, in a fractional reserve banking system, private banks are the multipliers of that money supply. Let's explain just quickly how that works. So let's just say that a central bank creates $100 worth of supply. And the first citizen to receive those $100 goes and deposits those $100 in Bank A. Now, let's assume that Bank A takes 50 of those dollars and issues a loan to a different private citizen who then deposits those funds in Bank B. So if you total the amount of deposits that are in the system, Bank A has $100, Bank B has $50, so there's total $150 worth of deposits in the system, when the central bank actually created only 100. This process through which it goes from 1 to 150 in the private banking system through fractional reserves is called the money multiplier effect. So great, that's an interesting base to set. So banks will essentially look to lend most of their deposits to maximize their profit. So how do the central banks deal with this is they set a minimum reserve requirement. These are client deposits that have to be held by the private banks in the central bank's reserves so that it knows that every private bank has enough deposits essentially to be solvent as per the thresholds that they set. So in theory, if there is more than one bank and there was essentially the amount of times that the money can bounce around from one bank to another will be set by several variables, but the main one being that minimum amount of reserves that the central bank requires. We can assume that if every bank in the system is basically required to have these reserves, then these will not be available to be lent out. So if we do that, then we get, and again, I'm just going to go to the actual money multiplier formula here from Wikipedia so that you guys can see it. If we do that, then essentially we arrive at the fact that the money multiplier can be very quickly calculated by dividing 1 over the reserve requirement, which is basically, as you can see here, this is the theory on how this number is calculated. So let's do a bit of history on the Federal Reserve's reserve requirements. The Federal Reserve requirements, I'm just looking here for the money multiplier. Here it is. So the Federal Reserve requirements used to be set at 10% by the Federal Reserve. This meant that banks had to hold 10% of their client deposits with the Fed. In March, as part of a sweeping set of changes that was done by the Fed, it removed entirely this reserve requirement ratio. It basically deleted it from 10% to 0%. So banks have no requirement to hold a single dollar of your deposits as of March in this year, banks in the United States. Now, the United States has essentially discontinued the money multiplier because obviously it makes no sense. However, with a little bit of work, we can calculate that same number into the current levels so that we can see where the money multiplier is in the States. In theory, based on all the moves that the Fed has done, it wants to move this money multiplier higher. But as we can see here, it's actually quite lower than it has been historically. And this is because banks are electively holding or choosing to hold higher levels of reserve than the Fed requires, and several other reasons. For example, when loans get issued into US companies, many times these loans don't go to pay other companies in the States, which is what would then send those dollars back to another US bank. Many times what happens is these US companies with these loan funds pay international suppliers so that those dollars don't make it back into the US system, which keeps this multiplier very low. And this is what the Fed essentially is trying to change. It does not want banks to hoard reserves, and it wants essentially economic activity in the United States to keep increasing. So it wants money to keep flowing to US businesses and households and essentially hitting other US bank accounts. So again, just to kind of show you when this happened and how serious the Fed is about this. So this is the actual announcement. It was done in March 15th. This is the Fed's website you see in the back of your screen. And The other piece that is just showing us how much the Fed is bought into this new policy is the fact that it's even suggesting to change definitions. This was done on December 22nd, so just last week. And it is basically proposing to update references to interest on required reserves and interest on excess reserves. It will be replaced with interest on reserve balances. So the word required is essentially removed entirely from this piece. Now, essentially, what it does when the U.S. eliminates the reserve requirement is that, in theory, this money multiplier could be infinity, because if reserve requirements equal to 0, then 1 over reserve requirements equals infinity. So that is essentially theoretically why this formula has been broken. And the Fed basically broke it on purpose, because it is seeing that a lot of the theories that it had been using are not necessarily playing out for the policy goals that it is looking to accomplish. So again, we see that even with an aggressive stance from the Fed, we can also track the level of deposits that are in a system. So just looking for the deposits here. Here we go. So here we see that even with the moves, and these are the total reserves of depository institutions with the Fed. The Fed is desperately trying to bring these levels down because it needs this money to go back into the economy. Right now, we see that the reserves that the banks are holding are north of $3 trillion. So this is essentially a lot of the gunpowder that the Fed wants to put to work. So just to recap, the Fed wants to put this money out into the economy. It has eliminated the reserve requirements from banks in an effort to get them to lend to businesses and households. It is also providing strong signals that this is not just a temporary move, but it is part of a broader policy shift. And this is perhaps in light of the Fed understanding that, in a way, it is the central bank for the world economy. That could explain why the money multiple was so subdued in the first place. Again, going back to this theme of when loans get issued to U.S. companies, they don't always end up in other U.S. companies. They might end up in the global financial system. So it's basically, for now, it desperately wants to put these $3 trillion of honeypot funds back to work in the U.S. economy. They're trying to encourage this any way they can. So this was just a way to highlight how they are so drastically shifting their stance on policy moves. Moving over to our Bitcoin mining difficulty commentary, we had a new difficulty adjustment kick in last night, which kept us relatively intact at 18.59 terahashes, down from 18.67 for a small change of negative 0.38%. Things have been somewhat quiet on the hash rate front despite the price rally, which may reflect some delays on the supply chain because of the virus and also the holidays. With the current price action, we do expect to see some pent-up hash rate come into the network in the first quarter of the year. Bull runs are famous for driving up prices of mining equipment and the corresponding supply shortages. So we do expect to see the floodgates open again Q1, Q2 of next year. So again, keeping our eye out on that hash rate coming onto the network. So in today's What's Ahead for the Week section, we're going to be sharing our thoughts on what's ahead for the year. So our thoughts on 2021. So as we close out a great but very volatile year for Bitcoin, let's reflect on some of the trends that played out this year and which ones are likely to continue into 2021. So let's start with the first one. 2020 was the year that Bitcoin was put through the test of fire and emerged as a reserve asset, being formally recognized as this not just by a niche technologist community, but by the world's top macro investors. Separately, in the words of the New York Times, 2020 was also the year that the Federal Reserve changed forever. The two, in our view, are very much related. As we have covered extensively in this publication, the Fed has completely shifted its policy stance and is aggressively pursuing a weaker dollar. This will very likely to continue into 2021, likely pushing Bitcoin farther into the limelight as a reserve asset. Separately, with MicroStrategies kickstarting the trend with its treasury purchases, other corporations, insurance companies, and even governments that are considering purchasing Bitcoin will be making key announcements in the first quarter and the second quarter of 2021. With Bitcoin formally being recognized as a reserve asset driving client demand, we will also likely expect to see a slew of investment in Bitcoin infrastructure from from fintech companies, as well as investments in Bitcoin infrastructures from banks, traditional banks. Another theme to watch out for is the Coinbase IPO, which will be an event to watch as a market catalyst. If, or rather when it is successful, it will create a precedent for others to follow. We expect to see mergers and acquisitions in this space, and maybe even a go public event through a SPAC, a special purpose acquisition corporation in the US stock market. Now, with the potential for a Bitcoin supercycle, there will be undoubtedly a push for regulation. Bad actor regimes will also try to benefit from Bitcoin, which will cause concern in developed markets. As an industry and separately, we are likely to see a renaissance in proof of reserves, which will be a great tool to show regulators operational robustness in our industry. There will also be a focus on KYC from regulators, which will likely fuel the bifurcation in KYC versus non-KYC product offerings that we are already starting to see in the market. This push can very well translate to pressure from governments on stablecoin issuers and privacy services such as mixers as well as privacy coins. And the recent events from the SEC towards Ripple have made it very clear that US regulators will enforce the rules in their turf. We are likely to see a lot more of that in 2021. On the macro side, the overarching theme will continue to be the dollar weakness. We will see inflation in the US dollar, which may push investors to exploring other asset classes and geographies, taking their low-cost dollars to invest in markets that have more attractive risk returns. As Michael Saylor noted, we are already seeing hyperinflation in desirable assets in US dollar terms. This is very key, and we will be breaking this down in our next BEC. As always, thank you so much for listening and tuning in and following us throughout the year. If you don't yet have a Ledn account, visit ledn.io and check out how you can start earning 6.25 APY on your Bitcoin in 2021 and then 12.25 APY on your USDC as of 2021. Thank you, everybody. Have a great end of the year, and we will see you next week.